Windfall Edutech Intermediate Module. Chapter 4. Economy and Equity Market, the Correlation. Economic Indicators. Inflation and Equity Market. Interest Rates and Equity Market. GDP and Equity Market. Rise in income levels and savings. How equity market affects economy. Current economic scenario, India. Economic indicators. An economic indicator is statistic about the economy. Economic indicators allow analysis of economic performance and predictions of future performance. Economic indicators can be classified into three categories according to their usual timing in relation to the business cycle: leading indicators, lagging indicators, and coincident indicators. Leading indicators are indicators that usually change before the economy as a whole changes. They are therefore useful as short-term predictors of the economy. Stock market returns are a leading indicator. The stock market usually begins to decline before the economy as a whole declines, and usually begins to improve before the general economy begins to recover from a slump. Lagging indicators are indicators that usually change after the economy as a whole does. Typically the lag is a few quarters of a year. The unemployment rate is a lagging indicator. Coincident indicators. Coincident indicators are those which change at approximately the same time as the whole economy, thereby providing information about the current state of the economy. Like personal income, there are many coincident economic indicators, such as gross domestic product, industrial production and retail sales are coincident indicators. A coincident index may be used to identify, after the fact, the dates of peaks and troughs in the business cycle. There are also three terms that describe an economic indicator's direction relative to the direction of the general economy. Procyclic indicators. They move in the same direction as the general economy. They increase when the economy is doing well, decrease when it is doing badly. Gross domestic product (GDP) is a procyclic indicator. Countercyclic indicators. They move in the opposite direction to the general economy. The unemployment rate is countercyclic, it rises when the economy is decreasing. Acyclic indicators. They are those with little or no correlation to the business cycle. They may rise or fall when the general economy is doing well, and may rise or fall when it is not doing well. Inflation and equity market. Inflation is a state in the economy of a country, when there is a price rise of goods as well as services. To meet the required price rise, individuals have to shell out more than is presumed. With increase in inflation, every sector of the economy is affected. Ranging from unemployment, interest rates, exchange rates, investment, stock markets, there is an aftermath of inflation in every sector. Inflation is bound to impact all sectors, either directly or indirectly. Inflation and stock market have a very close association. If there is inflation, stock markets are the worst affected. Prices of stocks are determined by the net earnings of a company. It depends on how much profit the company is likely to make in the long run or the near future. If it is reckoned that a company is likely to do well in the years to come, the stock prices of the company will escalate. On the other hand, if it is observed from trends that the company may not do well in the long run, the stock prices will not be high. In other words, the price of stocks are directly proportional to the performance of the company. In the event when inflation increases, the company earnings worth will also subside. Earnings worth will also subside. This will adversely affect the stock prices and eventually the returns. Effect of inflation on stock market is also evident from the fact that it increases the rates if interest. If the inflation rate is high, the interest rate is also high. In the wake of both inflation and interest rates being high, the creditor will have a tendency to compensate for the rise in interest rates. Therefore, the debtor has to avail of a loan at a higher rate. This plays a significant role in prohibiting funds from being invested in stock markets. When the government has enough fund to circulate in the market, the cost of goods, services usually go up. This leads to the decrease in the purchasing power of individuals. The value of money also decreases. In a nutshell, for the economy to flourish, inflation and stock market ought to be more conforming and predictable. Interest rates and equity market. There are some of the indirect links between interest rates and the stock market and show you how they might affect your life. The first indirect effect of an increased rate is that banks increase the rates that they charge their customers to borrow money. Individuals are affected through increases to credit card and mortgage interest rates, especially if they carry a variable interest rate. That is, people will spend less discretionary money, which will affect businesses' top and bottom lines, that is, revenues and profits. Businesses are not only indirectly, but also directly impacted by rise in interest rates. When the banks make borrowing more expensive, companies might not borrow as much and will pay a higher rate of interest on their loans. Less business spending can slow down the growth of a company, resulting in decreases in profit. One method of valuing a company: take the sum of all the expected future cash flows from that company discounted back to the present. To arrive at a stock's price, take the sum of the future discounted cash flow and divide it by the number of shares available. This price fluctuates as a result of the different expectations that people have about the company at different times. Because of those differences, they are willing to buy or sell shares at different prices. If a company is seen as cutting back on its growth spending or is making less profit, either through higher debt expenses or less revenue from consumers, then the estimated amount of future cash flows will drop. For many investors, a declining market or stock price is not a desirable outcome. Investors wish to see their invested money increase in value. Such gains come from stock price appreciation, the payment of dividends, or both. With a lowered expectation in the growth and future cash flows of the company, investors will not get as much growth from stock price appreciation, making stock ownership less desirable. Rise in interest rates makes borrowing money more expensive, which affects how consumers and businesses spend their money. This increases expenses for companies, lowering earnings somewhat for those with debt to pay. Finally, it tends to make the stock market a slightly less attractive place to investment. Interest rates are not the only determinant of stock prices, and there are many considerations that go into stock prices and the general trend of the market. An increased interest rate is only one of them. GDP and equity market. GDP is a measure of companies' overall economic output. It is the total market value of all the final goods and services produced by country. Countries and regions with strong long-term economic growth prospects are more likely to deliver higher stock returns than those with slower growth expectations. Corporate earnings in the aggregate should constitute roughly a constant percentage of GDP over the long run and, therefore, dividends will rise along with economic growth, thus producing higher stock returns in faster-growing economies. In the period between 1995 to 2004, the CAGR compounded annual growth rate of real GDP and the BSE Sensex shows a high degree of correlation. While real GDP has grown at 6.1%, Sensex has also posted similar gains. The crux of the issue is that an economy goes through business cycles of recovery, boom, slowdown and recession. Stock market also moves on similar pattern. For instance, if Indian GDP grows at 10% in one year, the Sensex may not gain similar percentage during the same year. However, the relationship may hold true over the longer term. It may be stated that the state of the economy has a bearing on the share prices, but the health of the stock market in the sense of a rising share price index is not reflective of an improvement in the health of the economy. Stock market capitalization to GDP ratio is used to determine whether the overall market is undervalued or overvalued. Stock market capitalization to GDP equals stock market capitalization, market GDP *100. Rise in income levels and savings. Rise in income levels will increase the purchasing power of consumers. Consumers would end up buying more stocks, which ultimately increases the liquidity of the stocks. Increase in liquidity results into increase in stock prices, and thus impacting positively on the stock market. Even rise in savings will push the liquidity levels of market, due to chunk of these savings coming into the capital market. How equity market affects economy. The stock market and the economy are closely interrelated, and the health of the stock market serves as an indicator for the health of the economy. A stock market index provides investors, economists and others a measure of the value of companies. Rising stock prices suggest a strong or improving economy, while declines or stagnant prices can indicate economic troubles. The value of stock affects whether or not a stockholder feels that it will be risky to spend money. Falls in stock will cause stockholders to spend less, causing a slowdown in the economy. Pension payouts are also reduced since much of the pensions are put into the stock market. News about bad stock markets cause consumers to become more careful about spending, which slows down the economy. Current economic scenario in India. Country's GDP growth in the third quarter of 2009-10 stood at 6.0% as against the growth of 6.2% registered in the same quarter of the previous year. The GDP growth for the whole fiscal 2009-10 was estimated to be 7.2% compared with the growth of 6.8% attained in 2007-08. The IIP numbers also show improvement in the economic situation. For the period from April to February of 2009-10 the production grew at 10%. This growth was much higher than the growth attained in the previous year. The inflow of foreign investments during the April to February period of 2010 was $33 billion United States dollars, which was $1.5 billion USD higher than the investments made in the previous year. In the end of 2009, the exporters again reported to get orders in good numbers. In February 2010, exports rose by 34.0% as against the rise of 23.0% in February, previous year. Inflation numbers are observed to rise again. Inflation has touched to 9.9% recently. The broad money supply continues to perform satisfactorily in the recent months as it grows at 13.7% from April to February 2009-10. Thank you. Revise and get ready for the next